Alrighty, folks, it is time for you and I to learn something new. For the longest time, I personally have been tracking the 10-year note to figure out where mortgage rates might be going. But in the non-QM space, it's not the 10-year, it's something else. Let's figure out what it is. Let's welcome Dustin and Jonathan to the show. How you guys doing?
Good. We missed you.
I missed you guys too. I miss talking to my friends every day. These are highlights of my day. So thank you guys for coming back each week. Thank you for doing a couple of videos where I was gone. Greatly appreciated. So tell us, give us some education. What should we be tracking in the non-QM space? Because it's not the 10-year.
Yeah. It's been historically, everyone in the conventional world is used to tracking the 10-year, right? And that's typically what it's been. On the non-QM space, more and more so. Obviously, there's not always a direct correlation, but
Sure.
more so than not, it's been tracking the 5-year treasury bond.
Oh,
So,
okay.
but right now, I think we checked, it was about the same. They're both like 4-1, but
Hmm.
for non-QM rates, mostly has been the 5-year. Especially because as we're getting more and more relationship with funds, because we're doing more volume on that side, the funds are telling us like, hey, they actually are shifting. They used to be like swap rates, and now they moved to the actual 5-year treasury. So
Interesting.
the market's been and this just kind of goes out to show you non-QM market is always changing, right? It's always going to be changing. Who knows, a year from now we might be back on swap rates, we might be on the 10-year, we might be on the 2-year, right? We don't know where it's going to
Okay.
be, but the index that they're tracking is there, where if the 5-year goes up or the 5-year goes down, typically that's the trend that it's following for the non-QM side.
So for the average person, someone like me who's, maybe been tracking more than the average person and just a mom and pop that doesn't know, Um, does the 5-year move more or less than the 10-year? I mean, why the 5 years? Is that just because the average mortgage duration is 5 years when they look at it? Any idea why they move from swaps to 5-year? I'm just trying to learn.
Yeah, no, a lot of our funds that we've spoken to, they're seeing an average, hold by the buyer or the person that's refining that we're selling the note to the fund, holding for 3 to 4 years. So they're going to use a 5-year bench.
That makes
Um,
sense.
yeah, and if you look at them, they both, the 5 and the 10 year, move pretty equal in terms of the amount of basis points moved daily,
Okay.
right? But as John said, Wall Street's always trying to figure out a better index to use so that they can write better papers. And it's not that,
Yeah.
the spread between the 10-year and where the average 30-year fixed, that average spread isn't always going to be the same as the average spread between either the 5-year treasury or the 5-year swap and the
Got it.
DSCR rate that we might get. Our margins are always changing for obvious reasons. We're starting to see the margins come down a little bit, which has also helped, for
Mhm.
lowering rates on the DSCR non-QM side. But it's just interesting to see because a lot of our clients we speak to are like, I saw the 10-year go to, 4-1 or 4-2. And a month ago, we were saying, well, the 5-year swap that we're using actually went up. So,
Ah,
it doesn't correlate.
Yeah.
got it. So that makes perfect sense to me because to me, it's always been about a duration match. In the conventional side, at least historically speaking, the average duration was 8 years. Hence, the 10-year always made sense. I think that's probably going to expand with all these people having 3% mortgages. We shall see later. But if the DSCR is 3 years, I think it makes perfect sense that the 5 years the benchmark. I had no idea.
Yeah. And then, I mean, for 30-year fixed loans too, for FHA conventional VA, a lot of them also track the 30-year mortgage-backed securities market as
Mm,
well, right? Because that's how it's packaged up and sold. So, that's typically like the secondary market where Wall Street trades. So that usually kind of moves inversely to the 10-year treasury. But, speaking of the 5-year as well and the recent drop, we've actually like seen with, especially with one of our funds, and I had a client. Oh, I hope you're okay. I had a client. I had a client basically call me and actually try to call the lender I was using and like be like, "Hey, do you guys have this rate? Is it real?" Because she couldn't believe it was real.
It's
And I,
it's the rate real.
yeah,
That's a
yeah, they
good
had a
sign that
broke.
you got a good rate.
Yeah, she had her old broker call and was like, "Hey, is this real?" Right? And they told her, "No, it's not real." Right?
Oh, wow.
Basically, but because it's not real for everyone else, It was real for us, but because of the volume that we put in, but it wasn't real for anyone else. So when they call in, they say, "Is this real?" They're gonna obviously say, "No, it's not real,"
Yeah,
because
'cause
they
they
don't
can't
want
get
to.
it.
Yeah,
Yeah.
they can't get it. But the market had dropped so much that now, I mean, on a 30-year fixed with it was with 20% down on a DSCR.
I did all these on the last video.
Oh, you did? Okay. Okay.
Yeah, but go ahead,
25,
say it
yeah.
again.
Yeah.
25% down. Go ahead. Tell us.
I mean, you can get all the way down to like 6.5 now, which and
Bananas.
it's
Bananas.
reasonable. I mean, you're paying like 2.5, 3 points, but it's still like you can get there, right? If you
Yeah.
never want to refinance again and you
Yeah.
know you want to hold on to it, your 6.5 honestly is a good rate, no matter
Yeah.
what the market is. You
Dude,
just
you
have a
could get
6.5.
this. You could get the seller to kick that in. I get asked all the
Exactly.
time, Zuber, do you buy down rates? And I go, yes and no. I go, every offer I send out has the seller kicking in. So I don't technically pay, seller pays. But yeah, I mean, if 2 points gets my rate down a point, you bet your ass I'm going to do that because I
Yeah,
want
it's
to
a
hold
no-brainer.
forever. Yeah.
Yeah, it's a no-brainer. And then you don't want to refi anyways too quickly with the
No.
leverage and the LTV not being high enough,
And the
or low enough.
prepays and all
Yeah.
that. Yeah.
So if you wanna, you're gonna keep it for a long time, you might as well, right? So that's kind of something interesting that we've seen happen in the market more often than not. And with that said, I mean, you can move on to what we were talking about after.
So one thing that obviously comes into play a lot now with the recent drop average is say 100 basis points across all products really. But the ones that we're seeing a hard time deciding whether it makes sense to refi are those that have prepayment penalties, right?
Yeah.
Um,
Yep.
we have a lot of clients that we wrote 2, 3, 4, 5 year prepays 2 years ago, a year ago, because they were
Sure.
getting 3 3s. Those people aren't coming back to us to
No.
want to refi, right? But those that we did a year ago that were at 7 or 8 now can get to 6.5, but they're stuck with the no, I got to pay a 3 or 2% penalty. Well,
Right.
we do have some good news is that now some of the funds that we're using will let us negotiate that prepay down. It's not a
Oh,
guarantee. It's not on every situation. It's got to make sure, for example, all payments have been made on time. No 15-day late sometimes may jeopardize it. The credit, if it's went below than what we submitted at, sometimes is a red flag. But we had a situation a month ago where we had a client that was in a 5 year prepay. We negotiated down to essentially instead of paying 4% to paying 2%. So
Yeah.
just things that we can do that can help, I guess, make it a little bit easier to want to refi if you need to refi, if you give us a call.
Yeah.
Yeah, I think at the end of the day, as the rate environment changes, the risk profile changes, you got to work with professionals who are in the business and willing to fight for you, as you did in that example. If somebody wanted to reach out to Convoy and see if you can help them, or maybe get some quotes, because we also had in the previous video FHA at 5.25. I couldn't believe you said that. That was bananas. 5.25. What are we doing? How would they do that? How do they reach out to you guys?
Go to convoyhomeloans.com and let us know you came from ORAT.
Thanks, guys. You got to tell them you came from ORAT so you get one of these two fine gentlemen. Else, you get somebody else. Take care.